Is a 7-Eleven franchise cost worth the profit potential? We're going to go through everything you need to know about franchise cost, potential profit, if you're looking to open up a 7-Eleven franchise in 2023. So 7-Eleven, different ways to spell it. Dash, just the numerical. 7-Eleven began its story in 1927 when Joe C. Thompson began selling milk, bread, and eggs across his stores. Until then, they were only selling blocks of ice. With growing success of his store's innovation, Joe Thompson was eventually able to buy Southland Ice Company. He then converted Southland Corporation, a company focused on opening convenience stores across the state. By 1946, the new store model had increased dramatically across several locations. His success led the stores to extend their operating hours from 7 a.m. until 11 p.m., hence 7-Eleven, 7 days a week. Franchising began in 1964 after the Southland Corporation purchased an additional 126 Speedy Mart franchise convenience stores, mostly in California. 7-Eleven currently has more than 9,000 stores across the United States, 10,000 plus across the world. Of the ones in the United States, 7,000 franchise stores, as well as initial 1,800 or so that are corporate owned and operated. Additional units in all over the place, Europe, Asia, and Mexico, throughout Latin America. If you want to open up a 7-Eleven, generally you're going to buy a 7-Eleven from corporate, where they're going to find the site, build out the site, have the initial inventory open up. So you can expect to pay anywhere from $47,000 up to $1.1 million for a 7-Eleven. The franchisor is looking for franchisees, prospective franchisees that already have a U.S. green card, U.S. citizenship. You also had to have previous management or customer service experience and have an excellent credit history. This franchise model is really structured in a way that you receive a fully stocked turnkey store. You have to also have minimum liquid assets ranging from $50,000 to $250,000 plus, depending on the store, the amount that you're paying to effectively buy the store, as well as 5 to 10 years of multi-unit management experience, preferably in convenience, retail, or food service industry. So they're pretty selective. So the calculations, it's a bit of a split profit model, but unlike Chick-fil-A, where you're getting basically the profit, the net profit together with the franchisor, 50% Chick-fil-A, 50% to you as the owner operator, and you only have to invest $10,000. 7-Eleven corporate's taking off the gross profit. So imagine you got gross profit $900,000 to $1.4 million per 7-Eleven's FDD. They're going to charge you $489,000 plus basically gross profit minus $900,000 times 0.58 divided by the gross profit for the last 12 months. They're taking off the top. They're taking a lot of money out of the business. It's not a standard royalty where it's simple, like 5%. It could be significantly more than that. So just understand what you're getting into. And we saw a similar model with Kumon. When we originally calculated the royalty, we had it way off. We were calculating a 12% royalty. Numerous Kumon franchisees were like, no, dummy, you're reading the FDD wrong. Our effective royalty is more like 30%. So we're not a big fan at Vetted Biz when you have complicated ways of paying the franchisor the royalty. It should just be a flat percentage, as well as if the franchisor is making money on selling you products, that's another red flag. So based on the median sales estimated for 7-Eleven franchise locations at an average 5% profit margin, we expect it's going to take about 9 years to recoup your initial capital investment. They do have big plans for 7-Eleven. They want to integrate their synergies with the Speedway brand, leverage scales of operational efficiencies, cost savings. They also want to expand the digital strategies, loyalty programs, and the 7NOW delivery. All these can help you as a franchisee. But it's just the financials seem a little tight, especially if you had invested like $500K or $1 million. It's hard to have 4, 5, 6, 7-Elevens. You generally own one, you generally own two, not a lot of margin for a day-to-day manager. So just be mindful of that. So with the lengthy payback period, the long hours in the store, it might be worth exploring another business model with split profits. We've looked at the past at Chick-fil-A's business model, Raising Cane's, which is no longer franchising, but they have a really good manager training program where you have a really nice upside, as well as Dutch Bros, which again is no longer franchising, but the store managers apparently make a ton of money. So it might be worth, if you're looking to get into the retail space, not to be a business owner, but be a very, very high paid manager as is the case effectively with the Chick-fil-A franchise, where Chick-fil-A operators are making in the range of $200,000 to $400,000 with just a $10,000 commitment. So for me, I don't see how the numbers for 7-Eleven add up, but don't take my word for it. Talk to some existing franchisees of 7-Eleven, as well as some former ones that recently left the system. If you currently own a 7-Eleven or are thinking about investing in a 7-Eleven, we'd love to hear from you. Shoot me an email at patrick@vettedbiz.com. Thank you.